You are looking at the market, seeing red everywhere, and you are panicking. CNBC, Z Business, Money Control, everyone is screaming market crash. And here's what happens next. You start checking your portfolio. It's down. You freak out. You think maybe I should sell before it drops further. But stop. Because what if I told you that this happens every single year? And yet the market still ends up higher over time. Let's break this down. Look at this chart right here. Since 1980, the Sensex has dropped at least 10% every single year. That's 41 out of last 45 years. Think about that. Big crash 2008, a brutal 60% drop. Average intra-year drop 10 to 20%. Only 4 years in the last 45 witnessed drops less than 10%. So a 10% intra-year drop is more common than you think. So, why is it that every time the market falls, people act like it's the end of the world? Because most investors are emotional, not logical. Here's how the market works. January 1st, the market opens. Throughout the year, it makes an intra-year high. Boom, a correction happens. December 31st, the market closes. That's the cycle. And guess what? The crash from high to low is known as the intra-year drawdown. The drawdown is usually more than 10% every year. Year 2023 had a drawdown of just 7%. Year 2024 had a drawdown of 10%. This usually happens every year as you can see. But there is hope. Even with these drops, Sensex has continued to hit all-time highs over and over again. Now, here's where it gets really interesting. Let's zoom out. Yes, market drops 10 to 20% every year. But you know what happens by December. Most years end positive. 3 out of every 4 years, Sensex closes higher than where it started in January. Even in years where there was a correction, the market bounced back. 36 out of 45 years ended positive. So think about that for a second. If you sold in panic every time the market dropped 10 to 20%, you would have missed out on the long term gains. The blue column in the image represents the calendar year returns of the Sensex from 1980 to 2024. These bars show how much the market gained positive returns from January 1st, the opening price, to December 31st, closing price for every year. Key takeaways from the blue columns. Most year ends positive. 36 out of last 45 years ended with positive returns. This means 3 out of every 4 years Sensex closes higher than it started. Even after crashes, the market recovers. Even when the market fell 10 to 20% during the year, intra-year crashes shown in the first image, the market often bounced back by year end. For example, in 2008, Sensex crashed 60%, but in 2009, it rebounded with a 76% gain. Some years had explosive growth. Look at 1985, 94%, 1991, 87%, and 2009 had 76% rally. These years saw massive returns. Investors who held their positions despite volatility benefited greatly. Short term drops is not long term losses. While some years end negative red bars, long term investors still saw growth over multiple years. Look, I get it. Watching your portfolio drop by 10 to 20% is painful. But if you believe in the long term growth of the economy, here's what you do: stay invested, rebalance smartly, avoid emotional decisions. Let me tell you the worst investing mistake you can make, that is selling in panic. Corrections shake out the weak hands. They reward those with patience. And the smart money, they buy when others are panicking. So let me ask you, are you someone who buys the dips or panics at every drop? Because data tells you exactly what happens if you stay invested. So next time the market crashes, remember this video, because volatility is a feature, not a bug. And if you don't know what to do, you need expert guidance. That's where companies like Moneydan.com come in. They are SEBI licensed advisors who help investors build real wealth no matter the market conditions.